of bringing other banks in Ethiopia or other financial players, how do you think it would sort of nudge the entire industry? Or would it even contribute in a great manner the way that we are imagining it should?
It depends on the time frame, really. But I mean, I think one thing everyone should know is banks don't like taking risk. Right? Banks do everything they can to avoid leaving risk on their balance sheet. Okay? So it looks like a bank's job is to lend money, but actually a bank's job is to find ways of lending money or utilizing its capital to maximize its return for shareholders. So one of the things that people often say is, well, if the banking system liberalizes in Ethiopia, early stage businesses will get more money. It's not necessarily true. I mean, it's possible because there are specialist banks that will think about that, but the cost of risk is the cost of risk. And right now, the cost of risk in Ethiopia, a reasonable return is north of 35-40%. So no one can actually borrow, inverted commas, or take money on that kind of basis unless they've got a very strong long-term plan with a lot of growth in it as well, and high margins and protected and blah, blah, blah. So the cost of risk is sort of the key question. I think the major benefit. Sorry, I know I'm timing. So obviously, if our banking system evolves effectively over the next sort of say 5 to 15 years, and you bring then foreign banks in the sort of 10 to 15 year horizon, then it will have positive but marginal effects. If you bring it in until the system is not ready to compete with it, then it'll have very dramatic effects. And the question is, how do you manage that? That's a big problem. Because if the banking system decides it's no longer in its interests to function at all, then the banking system that we do have will collapse. So you have to be very careful when introducing foreign capital, and in particular foreign intellectual capital into the market. I mean, I'm a big fan of bringing foreign banks here, as it happens, primarily because the intellectual property and capital that they bring will be super helpful. So the single most the single biggest everyone complains about customer service, product applicability, extent of lending, financial inclusion. That's sort of optically visible. But the biggest problem is there's no risk culture inside the banks here. Possibly understandably, because in the end, if you're only really lending against fixed assets and you're discounting them, or assets and you're discounting them from a loan to value perspective, then whilst there's a probability of default, the loss given default is assumed to be relatively small, if not zero. So as a credit portfolio manager, you don't have to worry too much about that. The distinction I would make is that all banks should be very sort of risk sensitive. They should price probability of default, exposure of default, and loss given default very carefully and collect data for it. Because then you can really attribute capital to different segments of the economy and to different individuals within each segment. So right now that risk culture doesn't exist. So most banks on the world, and I'm not necessarily completely up to speed on this, but sort of the global banks are regulated according to sort of Basel rules, Basel III plus whatever it is now, which requires all banks to measure all the risk across their portfolios in a very granular way. And risk is volatility of expected return. And how much capital you allocate to risk, i.e. volatility of expected return, is a function of a number of characteristics of the risk and its correlation with a wider portfolio. So no capital is allocated here on an economic basis. It's all sort of statutory. So my big concern is that as soon as the banks start trying to be more competitive or commercial or taking risk, even on a well compensated basis, they're not really measuring the risk, in particular the volatility of the expected return across a certain cohort or portfolio, which means that their solvency then is a question. So I think the biggest benefit of bringing foreign banks into this system will be to bring that sort of risk measurement culture into the Ethiopian banking system. And once you've got that risk measurement system built into your culture and DNA, and you still overlay good old-fashioned banking expertise and intuition, then you have a much more robust system. Right now, it would be very difficult to see that happening. So foreign banks would be good with that respect. The other sort of thing foreign banks, I think, would be helpful with is pushing forward the capital markets agenda. So the problem for a bank is that it doesn't want too many assets on its balance sheet because that reduces the return on the denominator. You want a return on economic capital invested into the bank. So most banks, so our Prime Minister, whom we love and adore, announced a couple of years ago that foreign mortgage lenders would suddenly arrive in Ethiopia, right, and transform the housing sector. Because there are three parts of the housing sector, right? There's the constructors, there's the banks, and there's the capital market. In other jurisdictions, there's hardly any mortgage risk left on bank balance sheets. It's almost all securitized. And consequently, the banks don't take that risk. They just take fees for originating and distributing that risk. That obviously can't happen here. So at the moment, because we don't have the infrastructure for it. Yeah. So if any foreign bank coming into this jurisdiction, its first question will be, well, how am I going to lay off this risk? Who am I going to sell it to? Because I don't like risk. And then the second question they have, which is a bit more fundamental, is how can I be sure that if I enforce on a mortgage, I can sell a property? Which, and that's not a problem just for Ethiopia. There are a number of jurisdictions where that uncertainty is difficult. But without those two things, it's very difficult to see mortgage lending being sort of internationalized, other than at rates which compensate for that risk.
So it's very interesting. Earlier you mentioned that some of these banks don't have this 10 years, 20 years sort of vision per se that is very practical. So I think the formation of capital market partly helps to sort of mitigate or alleviate some of the risk framework. But I think bringing foreign banks the intellectual property part of systemization of how do you mitigate risk and get out of this traditional old-fashioned sort of operating way of the banking industry. Now, let me just bring the private sector narrative, because we're in the private sector, startup space, and what have you. Now, if banks are not investing in private sector, particularly in startup, in SMEs and what have you, it's almost discouraging for anyone to start a company without a different source of funding. Now, the donor-funded environment, what have you, I mean, there's a pros and cons into how that resource is being utilized. But how do we bring the banking sector to be a critical player into the private sector, non-traditional private sector in the startup space? The risk is a lot higher. Failure rate's high, return is lower, versus where there's a reliable return that I can get for my dollar, right?
Sure. So, I mean, I don't think there's anywhere in the world that banks like lending to startups.
Yeah, true.
And so I think if our expectation is that, you know, foreign banks or other banks or different banks or a different regulatory environment will bring credit facilities to startups, then I think we're smoking dope. But there are two aspects to it, really. One is, and back to your question about investment banking. Yeah. So most investment banks either don't focus on early stage or they do focus on early stage. Very few do both. So the investment banking essentially is the way in which you disintermediate the banking market of normal lenders. So from an equity financing perspective, you need to develop that whole ecosystem. So investment banks, local capital markets, local private equity investors, and someone needs to bring it to bear, looking at one or two of you, for the early stage segment. It needs to be easily accessible, because it's actually, well, if you're doing deals of $20,000 or $100,000 or $400,000, and you want to make a living out of it as a counterparty providing advice or just broking, then you have to charge disproportionate fees. It's really difficult. So the other aspect is the banks themselves, often within their sort of new risk sort of management measurement culture, will say, well, despite the fact that I'm allowed to invest in private equity, it's still penal from a capital perspective because you can't leverage it 8 times or more. But they still have the ability to invest into private equity type assets. But even there, they have shareholders, right? And so if you want to know if your startup is going to get private equity funding from a bank, you have to talk to their shareholders to ask them what kind of risk-adjusted return from which segments of the economy they are expecting their agent, i.e. the CEO and his team, to go and find compensated risk. And the chances of it being in the sort of early stage is actually reasonably limited.
Yeah.
Banks are typically conservative, their shareholders are typically conservative.
Yeah.
So what you have in other jurisdictions is the development of sort of alternative financial institutions. Venture capital obviously arrives, but also government applies very sort of specific and clear underwriting and risk offtake, because the early stage system needs some kind of support, some kind of subsidy, not cash subsidy, but risk offtake.
Yeah.
So in the end, you have as the capital markets evolve and as the capacity to distribute risk to the right places becomes more effective, then all of these sorts of components exist. But that's why reform is so important, if we believe that early startups and early stage companies are the motor of job creation. Banks don't like risk, so don't look to the banks for support.
So a different dimension to that conversation. I remember when we were trying to raise seed capital, one venture firm asked me, so tell me about Ethiopia. I mean, obviously, so what kind of risk banks are taking? I said, so what do you mean when they lend money? For example, if you go to the bank with your intellectual property, your software, what have you, would they lend you money? It's like, no. Okay. What kind of appetite do they have for risk?
Yeah, but that's not a criticism of the bank, right?
No, it's not.
Right,
Not at all.
Because the environment doesn't allow
Not
it.
at all. So the way he's framing it is that if I bring my money in Ethiopia, is it a risk mitigation component? Whereby, or am I just 100% relying on your word, in your ability to actually turn around my money, make it profitable in a long term? That was really difficult for me.
You mean from equity risk or political risk?
Well, political risk is a known, it's a given. I mean,
Right.
No, equity risk. So I said, well, capital market discussion wasn't even on the horizon back then. So I guess the advent of capital market formation and what have you can also actually encourage investors to consider to come into the landscape. So that's, I think, probably...
Makes sense. So what's the number one question an investor's going to ask? Who knows the answer? How do I get out?
Yeah. So I was heading towards that. So you work with Moenko. What did you do with the bird? How did you help them? That was one question I repeatedly asked. Okay, I will make money in Ethiopia in bird. How do I get my money out?
Yeah. So currently, or rather, I'm not sure it's currently. I mean, it's really, really difficult. So the short answer is you don't. Now, if you are working formally within both the letter of the law, the spirit of the law, and the objective of the government when it wrote the law, then it's actually very hard to get the money out, both from in principle and then in practice. So in principle, there's a whole bunch of regulation which basically says your foreign exchange, any foreign exchange that you own or generate belongs to the government. We may or may not let you use some of it. Which, I don't know how that feels for people in this room, but for most foreign investors coming, it's like, it takes a long time to believe that statement, I mean, even sort of partially. Okay, so, because it just doesn't make any sense. It's my money. The second aspect is a bit more practical, which is, in the end, if the government is coordinating this system, whether they call it a waterfall or preferential allocation or whatever it might be, you've got to have sufficient dollars in for the dollars out. And to the extent that that's not the case, then I would argue, I think most people would argue, that paying dividends out of the country is a difficult proposition. Now, clearly, you want to make the case that this is an investable environment, so you need to be able to make the case that you can actually pay dividends or return capital when you sell a business on or offshore. But at the end of the day, if your priorities from time to time, although at the moment it's been a long time, are the basic necessities for life, then I think most people would say, fair enough, let's wait till the environment gets better. Then the other aspect is most of the people investing a lot of money are taking a very long-term horizon. Okay, so certainly anyone coming in the last 5 years that have been told, this is all going to be changed shortly. It's going to be changed in the next few years. And of course, there is evidence that it's going to change. IMF commitments, crawling exchange rates, looking for equilibrium, things that government ministers say all the time. So perhaps you can argue that we're closer today than we were 15 years ago or 10 years ago or 5 years ago. But it's still a massive, it's a risky decision for any government to take, making the currency convertible, if not tradable. So my expectation is that in this kind of current environment, it's still something down the pipe. Now, people tell me that it's actually very close now, but I think everyone has to form their view. So if you're taking most of these guys come and they say, well, we don't expect anything in the short term, but it's okay because we're pumping capex into the country. We've got lots of facilities to build, infrastructure to sort of build out, and so actually we don't really mind about the 7 to 10 year horizon, and it's bound to have changed by then. And actually, it might be worth taking a sort of a show of hands of whether or not people think we will have a liberalised FX regime in 3 years or 7 years, or what probabilities are. But I think it is a reasonably high expectation now.
So from your Moenco experience, what did you do? How did you solve that challenge and problem? Some might be interested to know.
Yeah. I mean, so actually, in the end, it took 2 EIC commissioners, 2 central bank governors, to explain, with the help of a whole bunch of people who know how the system works, that it was perfectly sensible, feasible, and in fact provided for in Ethiopian law for foreign-owned companies to reinvest stamped, that is to say, taxed dividends, as FDR, as foreign direct investment in Ethiopia. So that was basically the fundamental premise, is that if the government's not going to have enough foreign exchange to say, yeah, you can pay these dividends. If you imagine Moenco has a spreadsheet which shows dividend declared, dividends paid, cumulative unpaid dividend, going back to 2005 or something. So there's a lot of dividend declaration. There's a little bit of dividend payment, but a lot of cash sitting in the bank, which bizarrely is sitting in Moenco's bank accounts, and Ethiopia believes that's Moenco's money. But it's already taxed and declared as a dividend. So it's really Inchcape's money. It belongs to someone offshore. Yeah. So you have a number of distortions. And of course, there's quite. If you look across all the multinationals and add up all of the money that they have in all of the banks, they are a very significant funder of the banking system, and therefore, to the extent that they fund the economy, then the economy. If you imagine that tomorrow they could actually just convert that and pay it away, then we have an issue. Yeah. And of course, there's a whole bunch of Ethiopians who would also, quite rightly from a portfolio management perspective, say, I don't want to leave all of my money in birr. That doesn't make any sense. I need some of it, at least, to be in a different currency or in an asset that I can't purchase here. Yeah. So the amount of sort of money leaving will be significant. So Moenco's approach was essentially to establish this reinvestment mechanism. Eventually it became very clear. And we looked at a whole bunch of different reasonably large ticket investment opportunities. So we turned unpaid dividend into equity in operating businesses in Ethiopia, which we could then sell onshore or primarily offshore. Or if they could start paying dividends, then that would be great. But the idea was essentially to turn a dividend into an investment held offshore, so that we could at least claim to our auditors and our shareholders that we could sell those things without too much interference from the government. But of course, that goes back to Sam's answer, which is who are you going to sell it to? So in the end, not a lot of progress economically.
So this is very interesting. I remember having a conversation with Techno guys made lots of bird, they couldn't get it out. So they decided to start different ventures right now. They had meat production, export, restaurant, hotel, and this and that, but it worked. There are different regulations to sort of adhere to. Now, but it could also be an opportunity for foreign investors if they consider investing in other companies in Ethiopia. Equity investment.
That's what we're doing, and I think that's what. So if you talk to any of the multinationals, what they're looking for is sensible places to park their money. So if you think you've got $100 in birr in a bank, then how much do you invest in different? And it's all going to be invested, because you can't take it out. Where do you put it? So from a treasury perspective, it's cash. So the European sort of financial controller and treasurer says that's cash. I mean, I don't want that to be in a 7 to 15 year infrastructure project. I want it sort of reasonably liquid. I want to be able to sell it for a discount reasonably quickly if I choose to. So how do you allocate it? So at Moenco, for example, and I'm sure it's changed since then, but we can leave a whole load in cash, about half of it in cash, because you never know when it's going to be liberalised and/or what you might need the cash for in a reasonably tough operating environment. And then 25% will overinvest in the future footprint of Moenco itself. And then 25% we'll invest into crazy equity in either existing businesses or starting, where it made sense, starting a new business. Yeah. So all of the multinationals should be a reasonably sensible source of BER investment anyway. The difficulty comes when they explain what they're doing to their boards in London. So economically, it makes complete sense to put the money to work. Yeah. Because to your point, if you're never getting the money back, then it's worth nothing in dollars or sterling. So if you put it to work with no expectation of financial return, but just a change in your business profile, then there's an infinite return on that investment. Yeah. So in practice, if it was left to the people on the ground, a lot of money would be available, invested. Yeah. But it's not, because ultimately they report to boards in Joburg or Amsterdam or London or wherever it might be. And these guys are public company board members who, above all, want to avoid any embarrassing risks during their tenure. Yeah. So there's a whole bunch of additional risks that come with that investment. Beyond the Ethiopian risks.
Yeah, I understand. So for private sector startups trying to sort of sell our stories to investors that are not familiar to the Ethiopian market, aside from reading from any financial reports and what have you, how would you frame conversation? What kind of investors
to an early stage investor?
Should we even approach? Because this question, I mean, you bring your money, but the likelihood of getting out your dividend in a foreseeable future, probably not. For example, we raise seed capital convertible notes, right? I mean, we convert into equity, but still
locally, internationally.
But even if it's a growth company, the next round would be selling equity, right? And we would be raising money, but still that complexity of how do we pay the other investors elsewhere, bring some of the money that we need to grow. But at the same time, now we have different set of expectation, right? They still expect their dividend in 2 years or 3 years or what have you, right? Are you going to continuously raise money and dilute the company's sort of equity? It's just a bit complex. How would you frame the Ethiopian landscape for a potential investor? Hey, come to Ethiopia. There's tremendous amount of growth potential and market potential. But at the same time, there's a risk. How would you
so these financial investors or strategic investors? Or the early stage financial investors?
Just could be PE or angel or what have you. Yeah. The impact also is a little bit different because how they measure impact versus dividend is a little bit different, right?
But I think you just hit the nail on the head. I mean, so I think the problem is that no one who has a choice or very few people who have a choice would invest money into Ethiopia.
Okay.
But for all the reasons that we can allude to, if anyone disagrees, say so now. We can debate it because it's a key point, right? So why would you bring money into a jurisdiction where actually between sending the money and receiving the money in BER, you lose 50% of the perceived value of the investment? There's a lot of IRR to make back up from the operating entity, assuming that you can transmit it in due course. So, I mean, it sounds harsh, but actually the solution is right here. Local currency investors are likely to be the biggest driver of change. And the reason we haven't seen that and why it's slow to emerge is because of the regulatory environment. So at the moment, if you have spare cash and you're the kind of person who's wealthy enough to invest it into or support early stage businesses or funds, then you have a bunch of choices which make more sense probably in the current environment. In the end, if the return, if you're sensible and you say I want a 40% IRR on my investment, then an entrepreneur is quite likely going to say, well, that dilutes me out of sight, so
Sure.
I may as well not bother. But local currency investors, particularly if as the capital markets environment evolves, are likely to be the biggest source of funding for early stage investment in Ethiopia. Then, sort of not unrelated to that, of course, you have diaspora. And historically, they've been great supporters of early stage. And going forward, as the regulatory environment gets simpler and people break it down, then it's going to get that much easier. So that's probably sort of the next place to go. So I think, as you probably know, there's a number of different initiatives around the place to think, how can we systematize this approach so that it sort of democratizes access to diaspora money, rather than making it sort of based on whether you know enough people or your friends in the US can work it out for you. So there are a number of sort of approaches being developed which will hopefully systematize and democratize that, so that people who come here will just be able to click, and there'll be sort of 3 or 4 obvious places to go, and they can choose between the sort of the level of service or the price of the service for accessing, not necessarily guaranteeing, but accessing that potential pool of money. And then, so of course, I think you're alluding to donors and sort of development financiers, all necessary in this stage of development in this kind of jurisdiction. So people often complain about the donors and the sort of development finance companies, but in the end, there's no, as I said earlier, there's no jurisdiction in the world that doesn't subsidise the early stage. Our government here doesn't have the capacity to fund the cash necessary for it. It definitely has the capacity to provide risk offtake one way or another, which it doesn't do enough of for reasons I don't really understand. But a number of the donors and sort of development finance companies are taking risk off as well as putting financing in. The big problem with sort of all of that is it creates a sort of slight system of dependence, and the private sector players, given that it's a tough enough environment anyway, find it sort of, they're disincentivized from participating. So they spend a lot of time trying to figure out whether this particular group, are donor junkies, yes or no, and if they are, then what can you really do for them? But back to the sort of I guess the point of the question. It's incumbent on all of us, well, the sector, the economy as a whole, to sort of present to external investors who are rational, the kind of expectations they might reasonably have for returns over a longer period of time. Nothing's going to happen in the short term. And I think the more we tell people that, now is the time to invest in Ethiopia, everything is changing, it's all going to be fine tomorrow. There's a whole generation of investors that are lost to Ethiopia because investors don't have time to sort of try and understand why they were lied to. They'll just go somewhere else.
True.
So we have to be super careful, both as individuals, small companies, big companies, investment promotion organizations, to really sort of take a sort of equity investor relations mindset to that discussion and just be brutally honest.